It's a pleasure to have the one, the only Ben Rabidoux of North Cove Advisors. We're talking all things real estate, consumer. Ben, what's happening, man?
Hey, Thomas, good to see you, man.
Great to see you, man. You know what? We used to it was back on Bay Street days. We used to throw back pints and talk about, that'd be like a decade ago. Talk about just all that was brewing and the nonsense that the absolute this has been a carnival for some time, right? The housing market.
This is not a new story. This has been a wild ride. It feels we've been talking forever about what could possibly kind of upend or what's the word? Upend the apple cart. What's that saying? Overturn things and cause
the apple cart.
Right. And it was always like, well, there was a couple kind of potential catalysts, theoreticals floating out there. You had some things come and go. You had some little mini downturns here and there, but nothing that was like really a real test of this market. Now we've got a real interest rate cycle, and so if it's ever going to happen, if you're ever going to see kind of the rubber meet the road, it's got to be now, right?
Well, exactly, and coming to the main question, so this is why hasn't anything blown up already? Like, this has been an incredible rate hiking cycle, one of the fastest on record. Why why hasn't this blown up already? Like, how's the consumer still alive?
Yeah, great question. So I think there's kind of four main things that I'm focusing on, because you're absolutely right. Like if we had gone back a year and a half ago and said rates would be at kind of in the sixes, where do you think house prices and housing activity and all that and inventory levels would be? If you had that data ahead of time that rates would be this high, you would have gotten everything wrong, right? I would have anyways, right? Like I would have thought that things would be a smoldering ruin. And look, prices are still off, call it 11% nationally from peak, but that's not a disaster. And this is not a disastrous market. It's still a relatively tight market. There's not a ton of inventory. So what's happening, right? And I think there's kind of four main things that I would focus on. So first off, to get real distress in a housing market, you do need unemployment to rise. And we just have not really seen that yet. We've seen just an incredibly robust labor market. Now that's starting to change, right? So if you look at the unemployment rate, it's now risen 50 basis points in the last 3 months. That really does not happen outside a recession. So you are starting to see some tentative signs there. You look at things like the composite leading indicators from the OECD. They are at levels that historically have had a perfect track record of predicting recession, right? So they've only ever gotten this low 6 other times since the 1960s. Every time it's been recessionary. So, you see that. And then even things like this week, we got employment insurance claims, right? And they were up 16%. Month over month, seasonally adjusted in June. So you're seeing some signs that there's a bit of softness there. So, but all that being the case, the unemployment rate, the labor market's been remarkably strong. So that's kind of the first thing that I would point to. And then second, I'd say I think everybody, myself included, underestimated the magnitude of the savings that accumulated to households throughout the pandemic. And the Bank of Canada's done great work on this. And they basically said that if you look at it by income tiers, kind of the top quintile has effectively 10 months of liquid savings versus 4 months before the pandemic. Now that drops dramatically once you get into lower income tiers. But the point is, Canadians have accumulated a lot of savings. Now that's starting to change. So if you look at the Q1 savings rate, it was actually negative once you strip out mandatory pension contributions, which I like to do because that gives you a better sense of active savings, right? Because if you're contributing to CPP, that gets calculated in the savings rate, but it's not it's not like you're putting money aside voluntarily. And it's not like if you need that $100 back, you can go to CPP and be like, hey man, give me my contribution back because I got to make my mortgage payment. So it's not liquid savings. And so, that's the first quarter that's dipped negative since before the pandemic. So you're seeing signs that that's starting to burn down. You're seeing credit card debt rise, which generally is kind of indicative of a consumer that's struggling. So that's the second thing. The third one has just been the massive population growth that we've seen, which, look, we knew we would have solid population growth based on kind of the federal immigration targets of call it 500,000. What everybody missed was the size of the non-permanent resident boom. And there we're talking about international students and temporary workers. That cohort's expanded by almost 750,000 in the last year.
Yeah.
And when you do that, then that adds tremendous pressure on the rental market. And then when you get all this crazy pressure on the rental market, it in a roundabout way drives housing demand, both by people who are in the rental market and are like, this is crazy, I gotta own a place. or by prospective investors who pile in. And a lot of times what we're seeing is people buying single family houses, turning it into student accommodations and jamming like 10 or 15 kids in there, right? Which is crazy. So that's the third thing. And then the last thing is just like the structure of the mortgage market. We have not felt the full magnitude of the rate hikes yet because of things like the variable rate mortgages that have static payments, right? So in Canada, and this is sort of a strange concept, but about 80% of the variable rate mortgages have static payments.
Yeah.
And so as rates go up, the amortization automatically extends. Now, this is important because that's still about 35% of all mortgages outstanding are variable, right? And so one of the wild charts that I track is, okay, you've got this metric called the household debt service ratio, which is a really important indicator because it basically shows the share of disposable income at the aggregate level that goes towards servicing debt payments. And it's a really good predictor of things like consumer spending trends, because obviously as more income goes towards debt, you have less for spending. But it's also a really good predictor of things like non-performing loans, right? So as on the consumer and mortgage side, because as that ratio goes higher, it just becomes harder and harder to service those debts. And what's really fascinating is like that ratio is going up, but not as quickly as what you might expect. But then when you pull it apart and you look at the interest only component and the principal repayment component, they're going in completely opposite directions. And I have a chart that we can maybe throw up.
Yeah, I'll put it up.
Yeah, but it's a crazy chart, right? So you see interest component basically up to 15-year highs, principal repayment, it has dropped dramatically. And the reason for that is just that you now are at the point where, you like CIBC's mortgage book, 20% of it is negatively amortizing right now.
What?
Right. And so
like that's crazy. Like that's just a wild number. And just Ben, on that point, talking about like, we just haven't felt the full brunt. What's the like how much is the amortization extended, like the duration of these mortgages? Obviously, if payments are remaining static, it's pushing out the amortization significantly. I just don't know what the like how much has that been pushed out on average, or what are you seeing?
Yeah, so the banks actually disclose this, and I'm going to be ballparking it, so I'm sure somebody can correct you in the comments. But I know that before this rate hike cycle, the share of big bank mortgages that had amortizations in excess of 35 years was like sub 1%. Right? It was almost nothing.
Yeah.
And now you've got some of them. Now, off the top of my head, I think some of them are kind of 20, 25, 30%. Have amortizations in excess of 35 years. So it's a dramatic increase, and you're really seeing that in this aggregate data. And so my point is that's the fourth thing that's kind of holding things together, but that's not a permanent fix. And basically we have very big renewal years in both 2024 and 2025. And importantly, with those variable rate mortgages, when they renew, the law dictates that it reverts back to the original amortization schedule. And so now you've got to amortize a larger mortgage balance over a shorter remaining period. It's like a double hit. So a lot of those borrowers are facing payment increases 40, 50, 60% when they renew in 2024, 2025. And so those are really, to me, like those are the years where that's going to kind of, that rubber will meet the road. So that's kind of the four big things where I think like why it hasn't really had more of an impact. But I don't think any of those are permanent. And the other thing I would just point is like, on the population growth stuff, like I don't know if you're seeing it, but there's like been a dramatic tone change around, I think just the whole perception of immigration policy in Canada.
100%.
And I've been banging the drum on this. I'm completely in favor of the permanent immigration targets. Okay, so the feds have like a 500,000 roughly immigration targets, and look. Like I think that's open for discussion. I think there's a reasonable case to be made that maybe that's the right number. Maybe it should be higher. Maybe it should be lower. I don't know, but we shouldn't just like pull it out of the hat and be like, okay, this year it's 500,000. But like, well, why is it? Like, let's talk about that.
Right.
But that said, I don't fundamentally have an issue with that.
So Ben, maybe just a question on that. Like the right-sized immigration. I don't think anyone that's been a hallmark of what's made Canada a great country. But when you have rental stock at lows, it's just like surely there's a flexible way where we can we can adjust those targets according to like what we can actually intake, right? Sure.
This is really important, Thomas. Okay, so there's kind of two main things that are driving population growth right now. One is that federal target of permanent immigration. That's 500,000. Okay, but the population grew by 1.2 million last quarter on a year-over-year basis. So it's like, well, if you're targeting 500,000, how'd you get to 1.2 million?
Right.
And this is where my big issue is. So you've kind of got permanent residents adding 450, 500,000. Then you've got non-permanent residents, international students, temporary workers. That's been like 700,000 of that growth. Enormous. And so that to me is where the issue is, because
Right.
You think about international students. We've seen an absolute boom in international students. And fundamentally, this is like to me, this is a broken system, because the colleges and universities don't have a cap on how many international students they can bring in. They are incentivized to ramp up their enrollment, because you're talking about 2, 3, 4x the tuition for international students.
Yeah.
But there's no real oversight from the government, and there's no mandate that they provide the housing necessary to accommodate those students. And so like there's some low-hanging fruit here. And to me, that's a big area that needs to be addressed. And you're starting to see kind of like a tone change around that. Like a year ago, you couldn't talk about this. Like you'd be shouted down and canceled. And now everyone's like, hey, wait a minute, maybe we should be thinking about whether this is the right number, and maybe we should be tightening up those non-permanent resident cohorts. And I think that's what you're going to see. And if they do that, that's going to take a lot of steam out of the population growth that we've seen, right? It could easily, if you tighten that marginally, it could easily cut population growth in half. And you could be adding, 600,000, which I think is a much better number over the long term. Give us a chance to actually build the housing necessary for 600,000 versus 1.2 million.
No, well, Ben, you're highlighting a really important point. This is, these are the things we should be talking about. Like, this is, where we have breaks in the system. Let's address that, and, let's right size this. But, to your point, right, before you'd be shut it down. You can't be against this. But now at least, we're talking about people who can't, we've got a rental crisis, right? And, at the same time, all of these other wicks are lit. It's an incredible time and space right now. And so if I could just circle back, because I wrote down that, that aspect of, I think it was greater than 35 years, on the books. Before it was less than 1%. Now it's anywhere 25 to 30%. That's a significant amortization extensions that's been happening across the board. Looking at this, I think you said 24, 25 is when we'll start to see the renewal cycle. And by law, they have to bring the amortization period back. Is this where the government can say, well, wait a minute, the population, this is a significant part of your book, 30% of the population can't absorb 50% just big jump ups. Has there been conversations around that, or how are people, how's the government thinking about that? Or are they just, or how are they planning for that?
Yeah. So first off, I'd point out that you can look at like BNS and National are the two big banks that have true floating payment variable. So the interest rate hikes are passed on kind of like point for point. The other four of the big six have these kind of static payments.
Got it.
And at this point, we're not seeing like a dramatic difference in non-performing loans yet between the two. And so, now again, I think a lot of it gets back to like the built up savings, and just there's a bit of a buffer, and it's going to take time, but it's not like it's a crisis at those two. And so if it was, then maybe the government would have grounds to really kind of be like, okay, well, what the hell are we going to do with these other ones as they renew? So that's one thing. The other thing is just like, you get a bit of income growth. We have seen some strong wage growth. Like, I don't know that it's going to be cataclysmic, but I would say 30-40% increase in monthly payments is going to absolutely sap a lot of discretionary spending out of the economy, and it'll 100%. Definitely move the needle on mortgage delinquencies. Like, but it's also important to remember that they're absurdly low right now, right? Like, you're still 15 basis points of arrears. Long-term average is like 35, so you could double from here and still be kind of below normal levels, which is, I think, it's absolutely going to happen in the next year. You could even go up 3x from here and kind of not really be at like normal distressed kind of high end of the range. So there's a lot of room to see those things move higher before the government necessarily needs to panic. But that said, like, there's nothing that would stop them from saying, look, previously amortizations were capped at 30, we'll allow you to go up to 35 just because we recognize that rates are like that, you know, they of course
Right.
they're going to do stuff like that. That's
Yeah,
not
yeah.
going to change things, right? So like
No,
that,
no, yeah.
it's not like that is a complete solution. It means you go from your rates going 40% or payments going up 40% to going up 25 or 30%.
Yeah, yeah.
Right? Like it's not a solution. It's just it softens the blow at the edges. And I think of course they're going to do that.
Yeah. And maybe just on the consumer and just the indebtedness, obviously, as you're saying, right now we're not seeing the stress, but canary in the coal mine, you know, you get your debt service ratio that you mentioned, and I'll make sure to get that graph up. And then, but in addition to that, you're starting the credit card situation is like that surely is a leading indicator of things to come.
Yeah, I think so. So when you look at different credit products, so credit cards, secured lending like autos, you know, lines of credit, all of them are seeing delinquency rates that are basically up to like 2007 levels, with the exception of mortgages. And so to me, it's just like it's a natural order of operations. If you think about it in Canada, like no one just wakes up one day and defaults on a mortgage. There's like a normal process, and the first thing is you tighten your belt, and you're certainly starting to see that, right? I mean, it hasn't been super clear in the official retail sales data, but like look at the Canadian Tire report last week. Like it was really like pretty wild. They basically came out and were like, yeah, it's like consumers hit a wall in June according to our numbers.
Wow.
And so you're starting to see that. So that's the first thing that happens. The second thing is then you start defaulting on credit cards, and certainly we're seeing credit card arrears start to tick up, loss rates are ticking up, like not alarming levels, but certainly moving in the wrong direction. And then, you know, you roll that forward, you get a bit of softness in employment, and then it shows up in mortgages. And so we're probably still, I don't know, 3 to 6 months out. But that said, like you're starting to see pretty material increases in delinquencies in, for example, the non-prime lenders, right? So you've got like the, you know, Home Capital Equitables of the world. If you look at their latest quarters, like you had pretty material increases in non-performing loans there, which should be expected because that's, you know, it's important to remember those are 1 and 2 year terms on their non-prime loans, right? Which is a weird thing in Canada. We kind of like the non-prime segment tends to be kind of like 1 and 2 year bullet loans.
Right.
And there, like the renewal pain is very severe. Like if you took out a 2 year loan that's renewing today, you're looking at 450 basis point increase in rates. Like it's dramatic. Yeah, it's dramatic. So of course it would show up there first.
That's it's incredible how, like, you know, piecing, you know, all the pain pressure points, but they're coming, right? Like there's no question. You know, it's all tacking down. Now, with respect to the Bank of Canada, a rate hike cycle, you know, one of the fastest on record. Where do you know, maybe you reading through the tea leaves and just, you know, how you vision them going forward. Obviously, inflation is going to be a key input into that, but also vis-a-vis the U.S. and you know how we do that tango.
Yeah, with the heavy caveat here that I did not see the magnitude of rate hikes coming. I don't think anybody did, but I know there were some people out there that were calling for a lot more rate hikes than I was, and so, you know, they were very right on this. I think we've got one more in the tank. I think that markets are probably right. We're going to see one this fall, and then it's really hard to see much beyond that unless inflation really starts to rip away from them. But at this point, that doesn't look super likely. So I think probably the market's got it priced right, where we peak out at like 5.25. But importantly, and I think what the market's starting to wrestle with now is this idea that it's just not going to come down that quickly. And I absolutely am in that camp that we're just in a structurally higher inflation environment, and it's one of those kind of like once bitten, twice shy. They never make the same mistake twice. They always overcorrect on the other side, and they clearly left policy rates too low for too long. They're not going to make that mistake twice. And so I think they're going to be very slow in bringing that back, unless we see like real like risk of a financial crisis, not a run-of-the-mill recession, not just like your standard business cycle, but a true financial crisis. Then there's one policy playbook, and that's to cut rates to zero and go in QE, right? And so that they'll do that if we have a true financial crisis. But barring that, I think they're going to bottom out at like kind of like the 3% range, which means that, you know, 2-3 years from now, you're still going to be looking at mortgages in that kind of 4.5% range, which is a dramatically different environment than what we've seen in the past. Now, what worries me though is if you look in the US, like the consumers, and I've got this chart, if you look at that debt service ratio I was talking about, you look at the Canadian household debt service ratio versus the US, we've really never seen that gap as wide as it is right now between the two. And what it suggests is that there's a lot more policy room in the US, or a lot more room to absorb high rates, right? Because they've gone through a deleveraging cycle. Their households have locked into 30-year mortgages at ultra low rates. So like, it's just not going to hurt them the same way it will for us. And so if the Fed has to like keep its foot on the brakes, I guess, and tighten things, right?
Yeah.
I say foot on the gas, but that's not the right way. Like if they keep tightening, right? And we'll kind of import that tightness and import that monetary policy on our side. And really, like, the Bank of Canada controls the ultra short end. But once you're even out at the 5-year, like, it really tracks the US. And that's a real concern, because that's what prices our fixed rate mortgages. So there's always that risk that, like, even as Canada weakens, that the rate hike cycle will have less of an effect stateside, and they'll have to stay tighter than we would want to. So normally, like, throughout cycles, Canada and the US are more or less in tandem in terms of monetary policy. And you could make an argument that maybe the US has to be a little tighter for longer, and we could in theory import some of that.
Wow, I mean, that you make a great point there on just how the tether of the 5-year, right? Like, and it's how it really, the influence of US, the US rate, interest rates in that period as well, right? It's not as anchored to what what the Bank of Canada is going to do. It's a great point. And now, Ben, like, lots of interesting points here. Maybe putting it together. There was a great chart you tweeted out that silver lining. Looking in Canada across the country. What was interesting, you had a house percentage. It was house percentage change from peak. So basically, we had every region down. So Canada, as you mentioned earlier, was down in aggregate. It is down 11%. I'm looking at bad places. Let's look at London, Ontario, down north of 20%. Toronto is call it 13. But what was interesting, so this is price percentage change from peak. Calgary is flat. And I just kind of wanted to get your thoughts on, okay, so we have a lot of we have a lot of storm clouds. There's no doubt about that. But what's in terms of the patch, and maybe kind of some insights on is there a beacon here in the country of Canada?
Yeah, great reminder that there is no such thing as a Canadian housing market. It's a market of various regions with very different economic drivers at points in time. Starting in 2021, I started pounding the table that the easiest layup macro trade, and there's no like easy way to put it on per se, but the easiest call to make is that you'll see Calgary outperform the Canadian average. And whether that would come through just stronger price appreciation, or whether it would just hold in better while the rest of the country kind of like weakened, I just thought it was a layup. And part of that is just that prices were so beaten down. We're effectively getting to the point where they were below replacement costs. I mean, flat for over a decade, but yet you had just an economy that had gone through a bit of a rebalancing away from traditional oil and gas, and you're starting to see more of a kind of a tech and startup renaissance, which makes sense because you've got like these incredibly cheap startup costs. You've got incredibly favorable tax regimes across North America. You've got this incredibly well-educated young labor force. Like, there's no reason for Calgary not to do well. And it had just been so beaten down. You had population outflows for so many years. You're like, well, that's not going to go on forever. And you'd had like capex in the oil sands fall every year and drag on GDP. You're like, well, that's not going to go on forever. And so that to me was an easy call, and I still think there's more room for that to run. I think we're still in relatively early days. Look, you're starting to see some froth there, more in the condo space. You're seeing a lot of like pre-construction sales. Like, clearly a lot of people that were buying in Toronto are like, oh geez, the cash flows don't make sense, let's go to Calgary. And that worries me, but I think that's more of a story for like maybe late next year before it starts to really matter, because there's just not a lot in the construction pipeline relative to current demand. Which is always a sign of overbuilding. And so there's certain charts that I track, and they're not flashing red yet. So that was one area. The other area is Atlantic Canada. And it's interesting, like the two areas of the country that are relatively affordable are also the areas that are seeing dramatic interprovincial flows, right? So you're seeing strong flows of people from Ontario, less or so BC, but big flows from those provinces into Alberta and into Atlantic Canada. And I don't think that's going to change. I think that work from home is fundamentally a game changer for some of those areas. And I just think they're going to do better. And so, like, why wouldn't you, if you can pull that arbitrage off where you're selling in Ontario and being able to or if you're a young person and you're looking, well, where do I want to put roots down? Like, it's just hard to imagine that those areas aren't going to do well for a while longer.
Yeah, no, you make a great point. Like work from home has definitively changed how anyone should look at their, their housing situation. And I think employers are have to be flexible about, where they seek talent. And you're going to see hubs change. So I know anecdotally like that, that move from Toronto to Calgary and East Coast as well. But really you hear a lot about the Toronto Calgary kind of,
Yeah.
that flow, right?
Yep.
And one important thing we didn't touch on, and I end on this. We're in Toronto. I'm looking at like, we just see condos, like, sorry, we're seeing commercial real estate office towers empty, 50% of the people going in.
Yeah.
But you have on the condo side, on the rental side, real tightness. What that's clearly an area, and that's not just Toronto specific. That's that's a North American global problem. Work from home has changed the dynamics of the viability of these office towers. Is there like do we ever come back? How does it, and what's the distress for the underlying companies exposed, REITs, etc. And then B, is surely there's a way to use that to convert it to to condos or whatever. But I tweeted out something like that, and people were like, "Listen, it's not as simple to throw plumbing everywhere. It's not like a cheap and cheerful like like the little house flip that you do in Toronto. This is like a legit project." And so
Yeah.
I thought it would be interesting, actually, Ben. Maybe it's a project for us to do, is to be like, hey, listen, like figure out, take one of these towers, give me a floor, let me figure out the true cost of converting one of these. Who knows? But I'd love to kind of get your take on where that goes. If there's one thing that's there, it's these beaconing towers that are half empty.
Yeah, absolutely. So look, I think they've been doing this for a few years in Calgary because they're sort of like a few years ahead in terms of that commercial office kind of glut, especially on the office side. Man, I'm pretty sure I read that they've done a couple of major conversions there.
Okay.
It's not my bailiwick. I would not be the person to ask. I've read what you've read, which is just that this is a far more challenging thing to convert from office to residential. I'm not the expert on that. I wouldn't know. I mean, it seems to make sense to me. Like, why wouldn't you, right?
Yeah.
And now part of the issue with the rental side is, so right now we've got this absurd rental market where there's just like, I mean, inhumanely tight, like just absurd. And remember, like this gets back to the discussion around non-permanent residents, because if you take 750,000 non-permanent residents, like international students and temporary workers, they're all renters.
Yeah.
So if you throw 750,000 of them in the Canadian population in 1 year, like of course you're going to have an insane rental market. Now,
Of course.
the thing with that cohort is it's massively volatile. And every time that we have had a recession historically, that cohort actually shrinks. And this is something that not a lot of people talk about, right? And which kind of makes sense because if you got a lot of temporary workers, they're here when the labor market's tight and then they leave when the labor market loosens. That's actually definitionally the point of that program, is to meet those labor market needs. If the unemployment rate were to go up 200 basis points, you'll see a dramatic drop in temporary workers. And I think that's probably where we're going to go. So like, I think that some of the tightness in the rental market will sort of work its way out on its own over the next couple of years. Not to the point where it's a disaster by any means, but to the point where we're back to like pre-COVID levels, which is still a relatively tight market, but not like disastrously tight. So I think that's probably where we're going. Now you'd asked about, okay, work from home, is that like a permanent thing? Man, I don't know. I would kind of fade that a little bit. Like, I just feel like, at the end of the day, if you want to advance in a company, so much of it is around who you know, and it's the relationships that you have. And from working in an office, like you just can't build those relationships without being there. And I feel like it just takes some time. And once you get people that are all working from home and they're realizing, hey, that person that's gone into the office and knows that they're getting the promotions and I'm not, like it just takes some time. And then I think the culture will start to change where everyone's like, well, if I want to get promoted, I got to be there. I got to meet people. I got to be at these meetings. We got to go out for drinks after. And it's like the whole culture. And I just don't buy that that's gone forever. I think that you may see more of that kind of hybrid model maybe stick around a bit, but like this idea that we'll just have like the zombie apocalypse, like no one's downtown. It's just like, empty buildings. Like, I don't see it. I don't see it.
No,
I
no,
would rather.
I joke around with my neighbors. Like, it's never been easier enough. Like, for the dude that was just mediocre, all you got to do is show up with your lunch pail, man. Fucking just show up with
Totally.
your, show up with your lunch pail,
Totally. Go out
and
for drinks after. Totally.
and you'll go faster in your career than you would have ever in any other generation. Just show up to work.
100%.
And that's kind of what's lost. Like, there's a mentorship gap where, and it's on both sides. I'm not just saying, it's not just the Zoomers or whatever, it's not the 20 somethings. It's, it's the guys who have the experience too. They're like, I don't want to go to work. Right. So you've got this situation where you've got, seasoned veterans who are like, listen, my life's better kind of just, jamming at home. And and then you got the other side is, kids don't want to come. It's a weird dynamic where ultimately it leaves a generation, an age segment that, doesn't have the mentorship, and it's kind of, and maybe Twitter's the new mentorship route. Maybe it's just jamming on Spaces 24 hours a day. Who knows what the pathway is, but it's definitely not it's not the old style. If you are a mediocre somebody and you're just like, I just want to grind, you've never had it easier. Just show up.
I agree with that. I think that's exactly right. Yeah. I think it's a great take. Yeah, I agree.
Oh man, well, Ben, it's been an absolute pleasure. We'll have to do the next one at a pub here in Toronto, or here at Grizzle HQ next time you come through, guys. If you don't know, Ben has been the greatest analyst in Canadian housing. I've had the pleasure of knowing him for quite some time, man. It goes way back, and always great takes. Ben, thank you so much. North Cove Advisors, you guys, you're gonna see the link in the YouTube below. Hit that. Best insight. Full stop, Canadian housing consumer. Ben, thank you so much.
Thanks, Thomas. Good to see you, man.
Great to see you, man.